Are you someone who is confused about disability insurance, or maybe you have disability insurance or life insurance and you don't know if you have the right policy, if you have enough coverage, or what have you? Well, you're not alone. In this episode, I have a conversation with one of my dedicated colleagues in this finance insurance space where we break down some of the most important insurance decisions physicians face. Keep listening to hear what's in store. Hello, and welcome to the Wealth Minded MD podcast with your money best friend. I'm Dr. Lisha Taylor. And of course, I'm here to help you build wealth and make good money decisions so you can create the life you desire with more control over your time.
Lisha, can we talk about life insurance for a second? Because I feel like this is one of those things that people either avoid or overcomplicate.
Exactly. And honestly, a lot of us think we need these big, complicated, expensive policies when in reality, most people just need a solid term life insurance policy that actually protects their family.
And that's why we love working with PKA Insurance Group. They're independent brokers, which means that they're not tied to one company. They shop across all major carriers to find you the best option.
And what I really appreciate is that they're not trying to upsell you. They'll actually tell you what you do need, what you don't need, which is rare in the insurance world.
Exactly. Whether you're getting coverage for the first time or you already have a policy, they'll review what you have and let you know if it's solid or if there's something better or more affordable out there.
So if you've been putting off life insurance or wondering if you actually have the right policy or if your current policy is a good fit for you, this is your sign.
Reach out to PKA Insurance Group at pkainsurance.com or call 1-800-258-1018 to get started. And don't forget to tell him that we sent you. Also, the link is right in the show notes for your convenience. So click the link and get started today.
All right, y'all, I'm back for another solo pod, and actually only solo for a little bit because I'm going to have a conversation later with someone that I trust in this space. But just figured I'd give you all an update on my life. As I am recording this, I actually just got back from a sports conference in Seattle. This is one of the conferences that I look forward to each year. It's in a different city most of the time. Each year is in a different city. This city was in Seattle, and I just had a fantastic time. I got a chance to reconnect with some of the sports docs that I worked with out in LA, some of the docs that I know out in New York, as well as some of the docs kind of all over the United States. And so it was great. You know, I love a conference where I can learn new things, but also reconnect with people that I admire and get some new ideas for how I could move my career and my practice forward. And so, yeah, it was fun. You know, I probably drank way too much, to be honest, and didn't sleep enough. But overall, I just had a really fantastic time. I'm a sports doc, and one of the things that I love is like connecting with other docs who are doing things differently than I am. And I was reminded that the Olympics are coming to LA in 2028 and was given the opportunity to kind of fill out this form essentially to be one of the docs for Team USA. And so between completing that form and also being in communication with the USOPC, so United States Olympic and Paralympic Committee, and just seeing what opportunities are available, I'm really jazzed up about. You know, this is one of the things that I've always wanted to do is help out with the Olympics. And I firmly believe that life sometimes is about putting yourself in position to get some of the things that you've always desired. And unfortunately, people aren't always going to email us and knock on our door with new and incredible opportunities. Sometimes we got to go out and take them, or sometimes we have to be assertive in letting people know what our desires are. And just me getting access to that started from a conversation I had with one of my colleagues and just being honest and saying, you know what, you're doing really cool work. I'm doing really cool work. One of the things that I would love to do is work at the Olympics. Me having that conversation with him, he was like, oh, you do? Oh, well, let me get you in touch with the doctor that's in charge of that, or let me share this form with you. Let me help you out in this way. And so I was really reminded of the power of speaking your dreams out loud and the power of sharing your vision with other people, because sometimes those people are willing to help make those dreams come true. So I got back from a sports conference. It was fantastic. Got a chance to connect and eat lunch with and have dinner with some really awesome people. I got to give a shout out to my UCLA colleagues. Man, I love those folks so much. We are the most diverse group of people. And on the surface, people could look at us and say, what in the world could you all have in common? But I just think it is so incredible to connect and hang out with people that come from different backgrounds than I do, have different experiences than I do, but are all joined together by one common purpose, which is like sports medicine. And so, yeah, I just had a lovely time. I have been doing way too much traveling though lately. So I am kind of looking forward to chilling out, although we'll see how that whirls. As you all know, I love to travel and I love to go on vacation. And so we'll see how I'm balancing traveling and also like chilling out and relaxing. So it is a balance I am still working through. Nevertheless, I'm excited for what's in store. Okay, so in this episode, I'm very excited to come back to you all today with a conversation that I had with Pradeep Audho, who is the owner of PKA Insurance Group. And he is fantastic. And full disclosure, yes, he does partner with us for this podcast, but I started working with him, oh my gosh, maybe like 8 years ago before I even had a podcast. Like I had vetted or tried to vet several different insurance agents and brokers from various companies. And I decided to work with him on my own policy because I trusted him. Our conversations were easy. I felt like he was really transparent and he told me a lot of the information and explained things in a way that I could easily understand. And so we've kind of had this like working relationships ever since then and have supported each other. And I'm the kind of person where if you're my friend or if I believe in what you're doing, I want to support your business. And he is too. And so I love that relationship that we have. But I wanted him to come back on today because I think that at this time of the year, there are a lot of physicians in transition and usually in transition for a great reason because maybe you're advancing in your career or transitioning jobs or what have you. And during these periods of transition, one of my goals is to make sure that we are protecting ourselves. And so I wanted to have this conversation about how we could make sure that we're protecting ourselves and our money in the midst of transition. So without further ado, let's take you to the interview. Well, all right. We have, a previous guest back on this show. Pradeep Audho is joining us. He is the founder, manager, all the things with PKA Insurance Group. We know that our audience has heard about your company either from some of our podcasts, endorsements, or maybe they've listened to one of the other podcasts that you've done with us. But we wanted to bring you back on the show mainly because this time of the year, folks are graduating from medical school. They're finishing their residency training programs or their fellowship programs. They're transitioning either into training or into attending hood. And this is the time where people tend to have some financial questions. And I know that one of the questions might be, am I ready to buy a home? Should I buy a home? One of the questions might be, how do I get started investing? But one of the questions that they should be asking is also, how do I protect myself and my money now that I'm in this phase of my life and in this stage of my career? And although there are several different ways that people can protect themselves, one of those ways is through insurance, specifically through life insurance and disability insurance. And I know from talking to other doctors that that is not a sexy topic. Okay. They're like, what? I don't want to think about myself dying when it comes to life insurance. And I don't want to think about myself getting disabled when it comes to disability insurance. And that stuff costs and that stuff is expensive. And I hope I never need it. And maybe I think I already have some. And so there's a lot of misconceptions and apprehensions when it comes to this. But hopefully we can break that down today and eliminate the truth from the noise and get some clarity on this stuff. But thank you so much for joining us.
Good to be here. Good to be back. It's been a while.
It has been a while. It has been a while. All right. Well, let's just kind of dive right in. If you wouldn't mind maybe rehashing for our audience, like what initially drew you to specialize in life insurance and disability insurance, specifically when it comes to doctors. And if you wouldn't mind sharing some of the misconceptions that doctors have about insurance.
I just kind of fell into it. I used to be a software engineer slash IT person 27 years ago. I didn't enjoy it, so I felt I needed a career change. I was more of a social kind of person as opposed to someone who would just sit there and code. I had some friends in the business and I just kind of made the change. And it started with, one physician asked me for some help on a disability policy. And then it just kind of went from there. It's just knock wood, as long as you don't screw up. People send their friends. It just kind of grew from there. And that's how I got started. In terms of the misconceptions on insurance with doctors, I think a lot of times people think, oh, one, it's not going to happen to me, or it's a waste of money. In some ways, it could be a waste of money, but that's life. There's lots of things we spend money on that it's just never going to pay a benefit, but you need to have it in case you need it. A lot of people are never going to get disabled, but a lot of people are also going to get disabled. And obviously we're all going to die at some point. Yeah, I think People look at it as a waste of money, but I look at it more of it's just the cost of being alive, and that's just something you need to do to protect yourself and your family.
All right. Well, let's dive right into that, to the life insurance part. How do you think physicians should go about determining whether or not they need life insurance and how much they might need?
If you're single and if you drop dead tomorrow and no one would suffer financially, I don't see the need. You could go without it. There are some people that have the opinion that if you're healthy, you should buy it so you lock in your health. There's some merit there if you have a family history of certain things, diabetes, cancer, etc. It might make sense to have a policy sooner rather than later. But for the most part, if there's no financial need, I don't think it's necessary, especially for life insurance. If you have kids, if you have a mortgage, if you have a business partner that would suffer if you passed away, then it's absolutely necessary. Typically, we recommend that you should have at least 10 to 12 times your salary. Some people get more, some people get less. A lot of what's going to drive the decision is less to do with 10 times salary and more to do with the premium. What I've noticed is most people, they look at the pricing and they're like, yeah, I could do that. And they just buy based off of the premium. There's nothing wrong with that. But if you have kids, I think you have to look at a couple of things. If you passed away, what are you looking to fund? Are you looking to fund college, or you just want to get them to 18 and after that, my job's done, I've done my part? Not necessary to fund college, but everyone's got a different opinion on it. Typically, we just tell people 10 to 12 times. That's more than adequate. If you were to pass away, your partner or spouse would have enough money to invest and survive over the long haul.
Okay, yeah. So I think one of the things that I just took away from it, and it is always fun when I think something and you're saying it out loud, I'm like, I'm eating it up. We are on the same page here. But I want to emphasize one of the things that you said is that not everybody needs life insurance. And I think that that deserves us taking in, because my experience has been that when physicians and high income earners specifically start working with a financial advisor, one of the first things that that financial advisor will try to get them to do is purchase life insurance. And one of the things that we just heard you say, and I agree, is that not everybody needs it. Life insurance is not for you. It is for your family. It is for your dependents when you pass away. If you were to pass away tomorrow or the next year or the next 10 years or 20 years, would someone be impacted financially from you no longer being here? Yes, they would be sad. Yes, they would miss you and all of those things. But if no one would be impacted financially, then you don't need life insurance. So if you're not married and your spouse wouldn't be impacted financially, or you're not long-term partnered, your partner wouldn't be impacted financially. If you don't have children that would be impacted financially, or maybe you do have children, but you're at the age where your children are grown and self-sufficient. And so again, if you don't have people in your life, whether it's a partner, kids, extended family, whatever, that depend on you financially, then you may not need life insurance. And so I thank you for bringing that up. Conversely, though, if you do have those people, right, you have kids, you have a partner, that sort of thing, then you do need life insurance. And what I just heard you say as a general rule of thumb is that most people need enough life insurance to cover 10 to 12 times their income. So if they're a physician and they're making $200,000 a year, then 10 times that would be a policy that would pay out $2 million. Now, somebody probably hears that and is like, whoa, that seems like a lot, or whoa, that seems like more than I can afford. And I think what you also mentioned is that a lot of people make the decision on how much money they're going to get or how much of a benefit they're going to leave their heirs or their family. They base that amount on how much it costs per month, right? They're like, well, how much is that? Let me see if I can afford it. And I think the truth of the matter is a couple of things. Number one, you may already get some free amount through your job. I know that's very common in the physician world, that if you are an employed physician, then 9 times out of 10, your employer is going to pay for some amount of free term life insurance for you if you were to pass away. And usually that amount is around 2 times your income, up to a cap of around $500,000. And so if you didn't know that, or you're not sure if that applies to you, I would encourage you to look into or contact the human resources department at your job and just verify that that is true. But that tends to be the case. So you may already have some free amount available to you at your job. The problem is that it's insufficient, right? The amount that your job is going to give you if you pass away is vastly different from what you might need. If your job is capping your payout for your heirs at $500K, but we just said that you need $2 million, there's obviously a gap there. And so the amount that you get for free at your job may be insufficient. The other thing is that the pricing. And so I think that the price, and you probably agree with this, Pradeep, is that the price of the insurance, right, how much it costs you to have this benefit largely depends on the type of life insurance that you get. Can you talk briefly about like the difference between term life insurance that may pay out if you pass away within the next 20 or 30 years versus permanent life insurance in terms of a whole life insurance, index universal variable life, like those kinds of policies, and the difference of pricing in both of those policies?
Yeah, typically term insurance is going to be super cheap. significantly cheaper than whole life insurance. And the reason for that is term is protecting you for a specific period of time. So let's say you have a 30-year mortgage, you have some kids, you're thinking, okay, I need coverage. Let's say you're 30 years old. I need coverage at least till I'm 68 to 65. So you're going to buy a term policy that's going to cover you for that period of time. And the idea with term is you only need protection during your working years, and your dependents are no longer depending on you by that point. Your house hopefully is paid off, and hopefully you've stashed away a good amount of cash in your retirement and everything else. So term insurance is the cheapest form of life insurance because it's pure life insurance. It's not mingling investments with insurance or any type of savings vehicle. Think of it like car insurance. You're essentially paying in the event something were to happen to you, and that's it. You're not expecting a refund or a cash value. Whole life, on the other hand, is significantly more expensive. If you've ever priced it out, you'll see that difference. I had 2 clients who just graduated from residency, and a company that we're not going to mention somehow convinced them to commit $90,000 per year into whole life premiums. So someone referred them to me, and probably a week after they committed to that whole life policy, we were able to get them out of it. We got them double the coverage for about $8,000 per year instead of $90,000 per year.
Whoa. Okay, so let's just pause there. There were so many nuggets that you dropped. Number one, the biggest nugget I got was you saved somebody over $80,000 a year. Let's just put that on a billboard. Like, what? And so if you're paying over $1,000 a month for life insurance, chances are you're probably in some sort of permanent life insurance policy, and that you might be overpaying for the benefit your heirs or your family would receive. So let's just clear that up. And so y'all heard it here first. If you're somebody, you're like, oh, that's what I'm paying, or maybe you're paying more, I would encourage you to reach out to Pradeep and his team at PKA Insurance Group, because maybe they can lower that price for you. So that is great. Thank you for the clarity and for the confidence in your work. But I think also what you mentioned is so true, right? Whole life insurance tends to be way more expensive, as we just noted in your example, and term life insurance tends to be a lot cheaper. Let's just be fully transparent. You helped me get my own term life insurance policy a few months ago. Thank you for your help, by the way. And so let's just use me as an example. You know, I think I ended up taking out, you probably know this better than me, but I ended up taking out, I believe, a term 30-year policy. And I believe I pay maybe like $100 something a month. Correct me if I'm wrong. And that will pay out, I think it's a $2 million benefit, something along those lines. And so that's what we mean by cheap, like less than $100 a month for a benefit of millions of dollars, right?
Right.
That same benefit, if it were a whole life insurance policy, would probably cost 10 times as much. And so it's the difference of me paying around $100 versus $1,000 plus per month.
Yeah, and just quickly going back to that couple, they were sold it as an investment by this other company. So we did the math. If we had taken that difference and just give it to a Fidelity or a Vanguard or one of those, they would have significantly higher value over the life of that policy. But they wouldn't have life insurance. But the whole idea is you have assets. Why do you really need a life insurance policy at age 95?
Yeah.
Now, it has some uses. Obviously, I've had clients use it for estate planning purposes. So if you're worth a lot and you're going to have a tax problem. So it's not terrible from that angle. But I would say most people, your average person, shouldn't be getting into that.
Yeah, I think that's great. And I think that that deserves some emphasis too. You're like, hey, oftentimes people get these whole life insurance policies or these permanent life insurance policies because they want to be covered for their whole life, no matter when they pass away. But the problem is that, one, it's really expensive, as we talked about. Number two, they're sold this as an investment vehicle. Like, not only will you have this death benefit, but you will also have this cash value, or you will also have this investment pool that you can borrow from, and all of these things. And what you just emphasized is that, Lisha, if they had simply just invested that money on their own in a regular taxable brokerage account at Fidelity, Vanguard, whatever, they would come out significantly more ahead than what that life insurance was going to promise them or give them. And so even though it was sold to them as an investment vehicle, it really wasn't that great of an investment vehicle because they could have invested on their own or in a totally separate account and gotten much higher return. So thank you for bringing that to our attention. And I think the other thing that you emphasized was that, do you really need life insurance past a certain point? And I think that deserves a little bit of pause and reflection, because on the surface, I could understand why somebody might gravitate towards whole life insurance. they're thinking, well, don't I want to be covered no matter when I die? Like that seems like it's more secure. But the truth of the matter is exactly what you said. Oftentimes, a term policy is sufficient because you don't need life insurance for your whole life. You only need to cover it during the term of the time period in which you're still building wealth. And most people, most physicians especially, but generally most people, the time in which they're building wealth and accumulating assets is over the next 10, 20, 30 years. It's until age 60. After that point, they've got enough assets because they usually are retiring on their assets, right? And able to live off of them.
Right.
And so you don't need to cover yourself for your whole life. You only need to cover yourself for the term of the time period in which you're still building wealth and accumulating money in retirement accounts. Because up to that point, when you're in your 60s, if you pass away, you can give your heirs, your family, the money that's in your retirement accounts. You can give your heirs or your family the money that's in your brokerage account, the money that's in your savings account. And so you want to make sure that it's enough, which is why you want to be covered in case you were to unfortunately pass away sooner. But if you're going to die at the average age, which is in somebody's 70s or 80s, then oftentimes when you pass away, you can give them the money that's left over from your retirement accounts and investment accounts. And so you only need to cover yourself for the term of the time period in which you're still building wealth. And as we discovered, term life insurance is drastically cheaper. And you can just take the difference of what you're saving and put that into an investment account and outpace any return that you would have gotten from a whole life insurance policy. So thank you for that deep dive, Pradeep. Actually, Brittany and I actually did a whole episode on the dangers of whole life insurance. I think it was like a month ago or whatever. And so we'll have our editor link that in the show notes for folks who want to take an even deeper dive into life insurance. But I want to transition a little bit into disability insurance. And so, Pradeep, do you mind explaining why, for many physicians especially, disability insurance is arguably more important than life insurance for physicians earlier on in their careers?
Yeah, it's simple. You're spending all that time training, going to school, and now you need to protect that if something were to happen to you medically, whether it's an accident or a sickness or something unexpected that prevents you from performing your job. And then also everything we do in life depends on our salary. Vacations, food, housing, you need money. It's just how the world goes. So it's necessary because if something were to happen to you and you cannot work, you might have some coverage at work, but it's usually not enough. And you can't really count on Social Security. That's minimal at best. So yeah, that's the main reason, because everything we do depends on our income.
Yeah, I totally agree with you. I think the studies show that we're more likely to get disabled than we are to pass away earlier than expected. What do I mean by that? The average life expectancy, as I mentioned, is in their 70s. So more than likely, you're going to live to be in your 70s. But when it comes to disability, I think the studies now show that 1 in 7 physicians will get disabled in some type of way at some point in their career. And I'm not saying you're disabled to the point where you can't walk or you're disabled to the point where you can't talk or function. What I mean by disabled is you might have something, whether it is a chronic medical illness, an unfortunate diagnosis like cancer, an unfortunate thing like arthritis in your hands that prevents you from operating, or a mental health disorder, something in that realm that might prevent you from being able to work full time at your full capacity in medicine for a long period of time. 1 in 7 physicians, that happens to. You don't know if you're going to be that 1 in 7. And so you want to make sure that you are protected for the reason that you stated, Pradeep, which is that a lot of the things that we do in life depend on our ability to have an income, depend on money, and not only depend on just a little amount of money, but we've oftentimes made financial plans, borrowed money in the form of a mortgage, and all of that stuff depends on our ability to bring in a high income, oftentimes from our doctor's salaries. And so you need to make sure that if something were to happen to you and you couldn't work, that you could still have a decent income coming in that would allow you to pay your bills, cover and pay any childhood expenses that you need for your children, daycare, college expenses, help your spouse out, like all of those things. You need to make sure that you're covered. So that if you couldn't work, you have an income coming in. And that's what disability insurance does, specifically long-term disability insurance. It covers you in case you cannot work. And so now that we know that most physicians need it, right? Unless you're independently wealthy and you've got multiple millions of dollars in the bank, chances are you still need disability insurance. And although you might get some free amount through your job, oftentimes that free amount that we get through our job is insufficient. There's a cap to how much they're going to pay out. There's a lot of limitations on it, and it doesn't go with you. So if you were to switch jobs, you would no longer have access to that policy. And so it seems like we need something different or in addition to what we get for free at our jobs. Pradeep, do you mind explaining what are some features that physicians should look into when they are trying to decide on a strong long-term disability insurance policy?
Yeah, the key would be own occupation, or also called medical specialty, ONA, but essentially it protects you in your specialty. So what does that mean? Let's say you are a surgeon and you became disabled, you could no longer do surgeries. By having the own occupation definition on your policy, you have the flexibility where you could choose to either stay home and watch television, or if you're willing and able and you want to, go find another job and you could collect on the policy while still earning a new salary. So, for example, I have a dentist here in Massachusetts who has an ONAC policy. He started developing some tremors when he was about 44, and he can no longer practice dentistry. Currently, he is collecting about $17,000 per month, tax-free.
Wow. Say that again 10 times fast.
Yeah.
What? $17,000 a month?
Right.
Okay.
Plus, he had a group plan that was providing him about $7,000 per month.
Wow.
Because he had his own dental practice. So it was a small practice. The group plan that I found him offered a little bit of coverage. And so he's able to collect that. And he is looking at jobs with an insurance company analyzing dental claims. So he can't practice physically, but he could review a dental claim. So he'd be able to work in that position, collecting his tax-free money, and all is well in terms of financial stuff. Obviously, you're losing your career. That's a whole different conversation. So that's ONAC. It gives you that flexibility. If you choose to go do something else, you can. You can also choose to just not do anything. You're still going to get paid if you're not able to do your specialty. So ONAC is one. The other most important rider is the residual rider or partial rider. Residual will pay you a partial benefit if you are partially disabled, not totally disabled. So that way, let's say you're still able to work 3 days a week, but 2 days a week you cannot because of a medical condition. You'd be able to file and collect a partial benefit while still earning your salary 3 days a week. So that one's important because a lot of disabilities are partial, they're not total. We also recommend the cost of living adjustment, also called the inflation rider. The way that works is it's triggered when you're actually disabled. So you'd have to be disabled and you're collecting a monthly check. At the end of 12 months, if you're still disabled, they're going to bump your benefit up by 3% typically. Some companies, it's 3% flat, and some companies, it's up to 3% based on what the CPI is, so the Consumer Price Index. So a couple of years back when inflation was 9%, you're only getting 3. And then you also want to look at an FIO rider or a BIR rider, which is benefit increase or future increase. Every company calls it something else, but it's basically the ability to increase your coverage as your income goes up. So they're not going to have you medically requalify. You just have to provide evidence of how much money you're making, and then they would increase your coverage based on that. And then we also recommend the catastrophic disability benefit. Some people buy it, some people don't. It's an optional rider. I think it's important for residents because a resident is usually capped at $5,000 per month, typically. There's been some changes there. A few carriers are now going up to $7,500, but let's say you bought $5,000 per month. The catastrophic rider will give you an additional $5,000 per month if you have a severe disability where you're unable to perform 2 of the 6 activities of daily living on your own. So kind of like a long-term care trigger. So let's say you can't bathe yourself, feed yourself, put your clothes on, go to the bathroom, etc., and you need to hire a nurse's aide to take care of you or pay a family member to stay home and take care of you. The catastrophic rider will give you that additional $5,000 per month. The reason I tell residents to get it, one, you're young, it's relatively inexpensive, and it's essentially going to double your benefit if you have a severe disability. Now, when you become an attending, and if you were to bump that monthly benefit up to say 12 or 13,000 per month, you could drop the catastrophic rider at that point. Any rider on a policy could be dropped in the future if you choose to. It'll require some paperwork, but it's pretty easy to drop. So ONAC, inflation, residual, catastrophic. Some carriers offer a student loan rider. I don't see too many people buying that. It's not terrible. Some people do buy it, but what that does, it reimburses you for your student loan payments if you became disabled. So you would make the payment and then you'd have to send evidence that you paid the bill and the carrier will reimburse you each month. But again, I would say, I don't know how other brokers view it, but probably 1 out of 10 clients take that rider. Most people don't. And then there's also something called an automatic benefit increase rider. That's on some policies where for the first 4 or 5 years of your contract, they would automatically increase your benefit by 3 or 4% automatically. So they just send you a letter in the mail and they'll tell you, we're bumping your benefit up by 3% or 4%. This is going to be your new premium. If you accept it, do nothing, and it's added to the policy. You could choose not to accept it. It's optional. But yeah, those are some of the main riders that we have people consider.
Yeah, I think that's great to note. So, if you are somebody who maybe you don't even have your own long term disability insurance policy, and the only thing that you have access to is the free small amount that you get from your job, understand that one, you would benefit from having your own long term disability insurance policy to increase the benefit, right? Make sure that you and your family are fully covered in the event that you couldn't work. And you want to make sure that you have those riders, AKA added protections to your policy. Like you mentioned, I agree with you, Pradeep. The cost of living adjustment is extremely important. Partial disability, so in case you can work part time, it pays you until you get back to full time. The future purchase option, that's super important. Catastrophic rider, I don't see a lot of people get that. I don't even think I had that in my policy, to be honest. I did get the student loan rider, but now that I'm thinking about it, it probably wasn't necessary. I think for a lot of folks who only have federal loans, your federal loans will be discharged if you are permanently disabled.
One thing on that, I could be wrong, but we had looked into the federal student loan discharge. Your disability would have to be permanent.
Yes, that's what it says. So if you're permanently disabled, then you get them discharged.
As in, like, you can't do anything.
So the definition of disability for your federal student loans would have to meet that criteria, which might be different than the
Right.
criteria for your own policy. So I get what you're saying.
Which is ONOC. Your definition would be ONOC.
Yes,
For your student loan rider.
yes. So just to bring this home for folks who are listening, right? We want you to have a policy that will pay out your benefit if you cannot do your specialty full time. Even if you could do somebody else's specialty, even if you could be an admin and call people on the phone, right? If you can't do your specific specialty to the way that you do it full time, it still pays, even if you could do it a little bit part time. And that's great. But what we're talking about here in regards to student loans is, technically speaking, if you have federal student loans and you are permanently disabled based on the federal government's definition of disability, which is oftentimes way more strict and stringent, then technically speaking, your federal loans would be discharged. My experience, and yours might be similar, Pradeep, is that a lot of the doctors who end up taking disability insurance, they don't meet that severe of a definition. And so they might meet their own definition of disability based on their own individual policy because maybe they have arthritis or a tremor in their hands, but they don't meet the federal government's definition of disability. And so then their federal loans would not, in that case, be discharged, and they would have benefited from that student loan rider. My
Right.
experience, and you correct me if I'm wrong, is that the student loan rider is not that much. I think it added maybe like $5 a month or $2 a month or something very, very manageable. You know what? At this point, just add it on.
Right. Yeah.
I think I ended up getting it.
Also, once you pay off your student loans, you could drop that rider at any time.
You're like, hey, Lisha, you might need that little cup of coffee. You might appreciate it. Hey, I get you. I love it. I love the fact you're trying to save me money. This is great. This is great for us. What do you think are some common mistakes that people make when purchasing a disability insurance policy?
Delaying is a big one. I've had so many people reach out to me who didn't buy their policy during residency. And I'm thinking, with all these insurance people chasing after every resident, I'm shocked that a few somehow weren't aware. Every so often, I run into people who somehow never went around to getting the policy, and now they're reaching out. And the downside now is your 20% discount is no longer on the table. Now, depending on the carrier, those discounts are still available as an attending. So it's possible you could still get that 20% discount, but depends on the carrier, depends on which hospital you're going to go work for. But I would say delaying the policy is a significant mistake that a lot of people make, not buying it sooner because it is age-based. When you bought your policy, we had gotten you the unisex pricing. The year after, pretty much every carrier exited that unisex pricing business. So a lot of people had been delaying and delaying. They reached back out to me a year later. Now it's 40% more. So procrastination is a problem. I tell people a lot, you don't have to buy $5,000 of coverage. So companies like Principal, Emeritus, Standard, if you're a resident, you could buy as little as $1,000 per month just to lock in your health and have that increased rider on the policy that would still allow you to bump it up in the future. So instead of paying for $5,000, you just pay for $1,000 because most residents have some level of coverage at their GME program. So they'll have that plus $1,000. But if it's not in the budget, we could scale it back and at least get you some minimal level of coverage with the ability to bump it up in the future. So that's an important thing that a lot of people don't think about. They see the price for 5,000, they're like, nah. But you could scale it back to 1,000, at least lock your health in. So you don't have to worry about any medical changes that could impact.
Yeah. You know what? I think that deserves some emphasis is that number one, the biggest mistake people make is delaying buying it because they don't think they need it or they don't realize they need it. And the truth of the matter is, as you stated, the older you get, the more expensive it is, right? The insurance company is not in a charity business, right? They want to see if they can make some money. And if they think that you are older, AKA if you are older, then they think, okay, the chances of you getting disabled are probably higher because you're older and you probably are going to have more medical issues. So they're going to charge you more for it. And so getting it while you are younger is a smart move. Another thing that we discovered probably years ago when I got my policy was that it costs more if you buy it in different states. Paying attention to that, remember I
Yeah.
had a friend in California and she was like, why am I charged $200 a month when Lisha, I want the Lisha policy. And so you had to explain that people in California tend to have more risky hobbies. They go on hikes and, all that kind of stuff. And so it tends to increase the price. It may cost different amounts when you're in different states. One thing you mentioned is a unisex policy. People, I identify as female, she, her are my pronouns. It's not like I am non-binary or anything like that. It is literally that. I just thought I would clarify this. Insurance companies have done the research that has shown that women are more likely to actually utilize their disability insurance policies because of things that might increase their risk for being disabled, such as pregnancy. And so insurance companies tend to charge women more for disability insurance. Conversely, they charge men more for life insurance because they're more likely
Right.
to die sooner than the women are. And so
Correct.
just a little fun fact, but in terms of that, when I was buying my policy, which at this point was 8 or 9 years ago, it's been a long time, they had something called a unisex policy where they would charge men and women the same amount. They have since realized that is not a
Yep.
good business model. And so they have eliminated that. But that is, I think, what you meant by the unisex policy. And so I
Right, right,
figured
right.
I would, provide some clarity for folks who might have been a little confused.
I should have said gender neutral.
Gender
Sorry.
neutral. It's fine. It's fine. It's fine. No judgment here. And, I know that we're running short on time, but I wanted to give you a chance to kind of talk about this GSI policy, guaranteed standard issue policy, which would allow some physicians to get disability insurance without the medical underwriting. So without all the nosy medical questions, they are
Right, right.
guaranteed to get a policy, and how that oftentimes is applicable to a lot of people that are still in training, whether you're in residency training or fellowship. So I wanted to give you a chance to talk about GSI policy and this new sort of in-between policy that has just come on the market. So update us.
So GSI is guaranteed standard issue. Typically, let's say, for example, you're at Emory. The folks at Emory have access to a Guardian GSI, for example. So that means Guardian will sell them a policy that would allow them to qualify with zero medical questions. And they could buy 5,000 or 2,500 or whatever now and have the ability to bump it up when they become an attending all the way up to $15,000 per month without having to re-qualify or ever answering any medical questions. It's an easy process. You simply check a box, answer a few questions, no medical questions. They don't do a background check from anything medical. You get a policy within a few days. And the only downside on the GSI policy is every GSI policy has a 24-month limit on mental coverage, and you're capped at $15,000 per month, which is different than if you did a fully underwritten policy and you qualified medically, you would have the ability to go all the way up to $30,000 in the future. And most physicians, 15 is more than adequate. So I think the GSI is a good way to go. It's kind of tricky because some carriers, Guardian, for example, it's pretty much exclusive to people that only show Guardian. So don't expect the guy who's going to talk about your GSI policy to also show you Principal, Mass Mutual, Standard, Emeritus, etc. Their goal is to sell as much Guardian as possible.
Mm-hmm.
I'm not saying it's right or wrong, but that's just how it is. Because from Guardian's perspective, they need to protect their profits and their persistency and everything else. So you would go to an agent who specifically handles that program. And it varies from GME location to GME location. So the person who handles Emory might be different from the person who handles Mass General. We typically don't have access to most of the Guardian programs. We're blocked because we have decided that we're not going to only exclusively show Guardian. So we show everything. And then if someone needs a GSI, we tell them who offers it. They can go to that person and get it. And that's how that works. So that's your typical GSI program. Now, not every GME location has a GSI offer. The smaller ones typically don't. So like Morehouse, some of the smaller places in Oklahoma, Texas, etc., and pretty much nationwide, but the smaller GME programs don't have a GSI. So one of the carriers who I cannot mention, they recently launched something called a fallback option, where if you apply with them and you got declined or you got rated or a modified offer where they're excluding body parts or whatever, you could choose to accept a 75% guaranteed issue offer from them. And at least it gives you some level of coverage instead of having zero coverage. It's probably ideal for these smaller programs where there's no GSI with Guardian or Emeritus or one of these other companies. But yeah, that's something that just came out 2 weeks ago. So you would essentially have to apply, answer all the medical questions. And if they decline you or they give you a substandard offer, they will give you the choice to take $7,500 from them of ONA disability policy with no ability to increase it, but at least you have $7,500 per month. Which for a lot of physicians, if you're going to be working at a hospital and you have a group plan, typically 7,500 to 10,000 is the most of what you would end up getting anyway. But yeah, that's a new program that just came out. We're not allowed to mention the name of the carrier.
Got it. All right. Well, what I heard is that, hey, things are changing in the disability insurance space. And so, well, number one, if you don't have disability insurance, you probably need to contact an independent broker that can show you policies from various different companies so that you can select the policy that you like best. Understanding that a lot of people in training, residents, fellows, they may have access to this guaranteed standard issue policy where they get guaranteed a long-term disability insurance policy without having to answer all the nosy medical questions. And what I just heard you say is, hey, Lisha, there's a fallback option. And so for people who maybe don't have access to a GSI policy at their residency institution, or who have medical issues or whatever where they wouldn't qualify for their own policy outright, there's this fallback option that will still allow them to get some level of coverage. And I know that folks like yourself who are very skilled in getting people approved, you oftentimes can talk to people and know, okay, you have a good chance of getting approved for an independent policy, or you probably should go the GSI route, or you probably are a great candidate for this fallback option. And so for me, I'm like, I like that there are more options to get people covered, because I firmly believe that a lot of physicians who are not just like wealthy right now need some form of long-term disability insurance. And so the ability to get it covered, to have some sort of option and some sort of benefit in case they end up being the one of 7 physicians who ends up getting disabled, I think is a great thing. So this has been fantastic. I know we talked a little bit about these new options for disability insurance. We talked about life insurance and how oftentimes most docs are fine with term life insurance, how you can help them shop around and find hopefully an affordable price, how they might benefit from getting it even before they have kids, if they know they're going to have kids, to lock in that rate when they are young and healthy. Same thing for disability insurance. You want to lock in that rate when you're young and healthy. And so that's great. Can you tell our audience one more time how they can get in touch with you and your team if they want to purchase life insurance or disability insurance?
Yeah, so you could go to our website. It's www.pkainsurance.com. And just hit the contact us button right there. Or if you want instant term quotes, you could actually run quotes right there on the website. And we don't make you fill out, name, email, any of that. Just put in your date of birth and the system will tell you what the pricing looks like on average.
Okay, that sounds great.
Okay.
Thank you for giving us that info. Thanks for joining us on the pod. Hopefully those who listened learned something. And as always, if you have questions, feel free to email me, wealthmindedmd@gmail.com. All right, Pradeep, thanks so much for joining us. We appreciate you.
Thank you.
All right, y'all. Hopefully you enjoyed that interview that I had with Pradeep. And now we'll get into some fun money. All right, it's a little odd, me doing fun money by myself, but nevertheless, I will share. So something fun that I'm doing with money is spending money on my brothers for their birthdays. So this is the time of the year where both of my brothers have birthdays. And although we don't tend to get each other elaborate gifts for each other's birthday, we try to get each other at least something that we can enjoy. And so for my oldest brother, he loves whiskey, like in his home has different like fancy whiskeys and cognacs and things like that he will occasionally indulge in. And so one of the things that I spent my fun money on is buying him some chocolates with whiskey in them. So there's these whiskey chocolates that have Jack Daniels in them. And I figured, oh my gosh, this would be a cute treat for my brother. And so I bought them for him. And I also volunteered to babysit My brother has two sweet, adorable boys, and he doesn't live that far from me. And so while my sister-in-law and my brother go out whiskey tasting, I am going to watch the kiddos. So a little bit about how I'm spending, I guess, my money and my time for fun and also helping out my oldest brother for his birthday. Haven't decided what I'm going to get my other brother for his birthday, but at least I've got one brother covered. And so that's a little bit about how I'm spending my money for fun. Hopefully you are spending your money for fun as well. Thanks for listening, and I can't wait to come back to you again next week.
Hello, everybody. It's me, Brooke. I'm recording a little disclaimer for my mommy, Dr. Brittany Halford, and her friend, Dr. Lisha Taylor. Just so you know, they're not financial advisors, tax professionals, lawyers, or financial planners. Everything you hear is for education and entertainment. It's not strict financial advice, you know. So use your best judgment, chat with a tax professional, and all those other people that you need to talk to. Thanks for tuning in today. Keep cruising on your journey to wealth and wellness. Bye-bye.